Hey everyone, welcome back to The Explainer. Today, we're diving into something totally fascinating, a strategic intelligence briefing from May 2026, aimed right at the South African insurance industry. We're going to impartially break down exactly how some massive political, regulatory, and economic shifts are fundamentally rewiring risk and opportunity across the entire sector. Let's jump right in. Here's how we're going to tackle this today. First, we'll look at the compound fragility crisis. Then we'll map out 4 interconnected systemic shocks. After that, we're going to uncover some incredibly lucrative hidden profit pools. And finally, we'll hit you with the ultimate contrarian reality. All right, let's start with part 1, the compound fragility crisis. So, back in May 2026, 2 massive things happened. The Constitutional Court reserved judgment on the National Health Insurance or NHI Act, and the Fala Fala presidential impeachment process flared up again. Now, most of the industry looked at these as isolated sequential events that you could just monitor one by one. Big mistake. We're actually looking at a new aggregate system fragility score that's jumped up to 6.9 out of 10. These are correlated triggers happening all at once. And honestly, current capital buffers just aren't built to absorb this kind of compound pressure. If you're modeling risk right now, this assumption that disruptions will be manageable and sequential is absolutely your biggest blind spot.
So what exactly are these compound pressures? Let's move to Section 2 and examine the 4 interconnected systemic shocks the market is largely ignoring.
Okay, shock number 1 is political. Everyone's worried about a presidential impeachment, but the parliamentary math makes that highly improbable. The real, underestimated risk here, it's actually the Democratic Alliance exiting the government of national unity. That kind of move forces new coalition talks and completely paralyzes legislation, specifically delaying the crucial Conduct of Financial Institutions bill by a good 12 to 18 months. That creates a massive regulatory vacuum, which ultimately triggers severe capital adequacy disputes with regulators. People are bracing for total government collapse while completely missing this highly probable legislative gridlock.
Moving on to the second shock, regulatory. The conventional wisdom in the private healthcare sector is basically, the NHI will be tied up in court forever. The status quo is safe. But what if the Constitutional Court actually upholds the act on procedural grounds? Suddenly, an existential 10-year restructuring is crammed into just 3 to 5 years. And just like that, the actuarial math holding up those mandatory minimum benefit reserves the capital schemes are legally required to hold for essential care is completely destabilized. And here's the kicker. This regulatory shock isn't happening in a vacuum. It's crashing right into an environment where margins are already brutally squeezed. Think about it. While baseline consumer inflation is hovering around 3.7%, medical inflation is running incredibly hot, somewhere between 8 and 10%. So medical schemes are getting hit with massive structural regulatory overhauls right as their operating margins are practically vanishing. That is compound fragility in action. Shock number 3 is wild. AI-generated fraud. I know, it sounds like pure sci-fi until you're actually paying out claims for it, right? But AI platforms, re-engineered as Fraud GPT and Worm GPT, are out there generating flawless phishing emails and totally convincing synthetic images of burst geysers and staged car accidents. This isn't just a bump in normal fraud, it's a fundamental category change. Traditional detection models look for human error, like bad grammar or weird timing. AI is specifically designed to eliminate those exact errors. The industry basically has a massive structural blind spot to this new class of synthetic claims. The fourth shock is macroeconomic, triggered by a global conflict like an Iran war oil shock. A severe reserve bank scenario puts the repo rate shooting over 8%, inflation ticking up, and the rand bleeding out to around 19 or 20 against the dollar. The real danger here? South African insurers are treating this like a generic, broad economic warning instead of a highly targeted, immediate threat to their own underwriting costs. Let's follow the dominoes on how this actually plays out. Say in January 2026, insurers buy below-cost reinsurance treaties. In April, that severe macro scenario hits. Come July, when US dollar-denominated treaties renew, a depreciated rand suddenly makes them up to 35% more expensive in local terms. To afford that, insurers are forced to keep more risk on their own balance sheets. Then October rolls around, peak storm season. A major catastrophe hits, and because insurers absorb that extra risk back in July, mid-tier balance sheets start snapping. This traces exactly how global volatility becomes a domestic capacity crisis. All right, if you're feeling overwhelmed, take a breath. Section 3, uncovering hidden profit pools. Because where there is massive structural disruption, there is massive first-mover advantage. Take the gap cover market, for example.
Conventionally, this is bounded by the roughly 9 million South Africans who already have medical scheme memberships, just covering the shortfall for doctors' bills. But the looming NHI uncertainty has triggered a massive psychological shift. People who thought their standard medical cover was comprehensive are realizing it might not be. Gap cover is transforming from a niche top-up product into total healthcare financial uncertainty insurance. That is an overnight expansion of the addressable market, essentially creating permanent demand for constitutional risk cover.
We're seeing a similar hidden pool in directors and officers, or D&O liability. Global pricing models usually lag behind real-world events by about 6 to 12 months, but right now, directors of state-adjacent entities, think municipal utility boards or infrastructure contractors, are facing immediate, severe governance liability risks simply because of instability within the government of national unity. Global models just haven't priced the specific South African political risk in yet. That's a 15 to 25% repricing opportunity for insurers who realize this and adjust their premiums today, before the claims hit.
Our third profit pool is purely behavioral, and it surrounds the two-pot retirement system. This system allows for early withdrawals from savings. But here's what happens. When financially stressed people pull from their savings pot, they often accidentally let their attached life or risk cover lapse because they are just shuffling funds around to survive. Offering automatic lapse protection, like grace periods or premium holidays, for the 6 million formerly employed South Africans in this system is a completely unexploited massive behavioral market just waiting for the right product.
So what's the tactical playbook right now? Well, insurers must commission comprehensive fragility stress tests immediately, using that severe macro scenario, and definitely lock in RAND-denominated reinsurance before those July renewals bite. Brokers, you need to build NHI scenario advisories to actually guide clients, rather than reacting alongside them, and review any state-adjacent D&O exposure. Regulators, meanwhile, have got to preemptively publish AI guidelines to manage this impending wave of synthetic claims.
Which brings us to our final part, Section 4, the ultimate contrarian reality.
This is the paradigm-shifting insight that challenges literally everything the industry believes right now. Let's look at the cold hard numbers. Medical scheme membership in South Africa isn't just stagnating, it is actively bleeding up to 250,000 beneficiaries every single year. And the vital takeaway here? This massive bleed is happening entirely independent of the NHI legislation.
The real threat isn't the NHI, it is affordability. Think about it. The medical scheme industry is pouring millions of rand and years of effort into a legal war against the NHI. But meanwhile, 8 to 10% premium increases are consistently outpacing income growth. The middle class is simply being priced out of private healthcare. The industry is so hyper-focused on fighting the legislative framework that it is completely ignoring the underlying economic realities that are destroying its customer base.
Which leaves us with this final provocative question posed by the briefing. Is the industry saving the legal framework, but losing the market entirely? I mean, is this intense focus on the shaking constitutional scaffolding blinding these institutions to the fact that the building they are protecting might be completely empty? Understanding these hidden risks is really the only way to build true anti-fragility. Thanks so much for joining me on this explainer, and as always, keep questioning the consensus.